Vinney Smile Chopra, a man who took $7 to a portfolio of over $250 million in apartment investing. He mentors and coaches to make apartment syndication easy. Each week, he will share his expertise, tricks, trades, and golden nuggets how to master the art of syndication to bring cash flow streams to your business, to change your life for the better. Here is Mr. Smiles.
Syndication Made Easy with your hosts, Vinney Chopra, and co-host, Alicia DeBrell. Hi, guys. This is exciting. Hi, Vinney. How you doing this morning?
I'm doing great. Thank you, Alicia. It's such a pleasure. Bright, nice morning here in San Francisco. Yeah.
It's always shining over there. Over here, it's raining. I'm in Texas.
Hey, Texas rains a lot. I own so many properties near Houston. I can vouch for it. So many rains. I've never seen so much rain there.
I know. And the weather here, it could be like 40 at night and then like 80 during the day.
Oh my gosh.
It's insane. I'm like, okay, so do I put a jacket on my kid to go to school or do I not? Because by the time she gets out, it's 80 degrees. She goes to school at 7 o'clock in the morning. But anyways, I want to talk about something that, I think is key. And if you don't have your crap together, could actually get you in a lot of trouble. But if you do have your crap together when it comes to this subject, it's something that can work in your benefit, and that's taxes and dealing with taxes in the multifamily syndication business. And since you're the pro, I'm going to come to you on this one.
Oh, so, I think that's a great topic. Yeah.
How do taxes affect the difference between, like, let's just say I'm doing a single family home or something like that type of investment versus a multifamily investment?
Love to.
What's the difference?
This is something actually a lot of my investors talk about, and we talk about in our underwritings also when we are looking at the properties, Alicia. And, as a matter of fact, my wife's thumb of rule is make more money, pay more taxes.
Love it.
But in the other hand, I would like to teach and share. A lot of audience might be new to the world of syndication maybe, or even investing. But let's take it from this ground level, right? So taxes are business taxes, personal taxes. So you are able to actually, when you earn W-2 income, you are paying that in your 1040, all the form and everything, easy form or more elaborate. When you start getting into a real estate, like a single family home, you run that as an entity because you got the rents collected, expenses, all that, right? And depreciation. Usually depreciation is a straight line depreciation for single family home, and it's a paper loss. What's paper loss? Paper loss means
paper loss. I like it.
Giving you in the tax schedule, like this property is going to go to zero value structure, not the land. Land does not depreciate at all, right? Okay. But the structure, the building
itself, yes,
only go for 27 and a half years at this time. But at 27 and a half years from today, it's going to be worth zero. So that's what we say. Depreciation is the word, right? A lot of people know that. So depreciation straight line is what most of the people do in single family home. When you're buying it, or duplex also, a lot of people will do straight line, fourplex, because the other word against the straight line depreciation is cost segregation. Okay.
Cost segregation. Okay.
Cost segregation or accelerated depreciation. So I'm an engineer.
Now you got me. Okay. You got me on the second part. You didn't have me on the first one.
Straight line means you're just taking the total building cost, right? Not the land. Building cost, like if it's a $10 million building, $2 million if it's the land value, $8 million can be depreciated, right? Okay. Because the land stays the land. Dirt is dirt is dirt. Even if the building goes
down. I like
it.
Dirt is dirt.
Yeah, dirt is dirt. So actually we take that 8 million divided by 27 and a half, you come up with a straight line, just like a straight line average, right? Accelerated depreciation, just like the word says accelerated, it accelerates the depreciation dollars in the first year, 5 year, 7.5, 15 years, like that.
So you have to take that into account ahead of time.
Right.
Okay.
So we hire an outside company. I'm not a CPA, I'm not an attorney, but hire another CPA firm that specializes in breaking down the whole structure of the apartment, or even 5 units, 10 units. You can do it for as many, because what they do is they look at all the different flooring costs and the lighting. I mean,
the flipping of like people coming in and out when you take over the property. I think I forget what you call it.
CAPEX.
It's sitting on the tip of my tongue. That's not what the word I was looking for, but like, because when you take over a property, you're automatically going to take some loss, and you need to be prepared for that. And
yes, bad debt. Now that is separate, by the way. The bad debt is a little different. That's in the income category.
Okay.
What we are talking about in the accelerated depreciation is that you are only taking the structure, which is the units, the cabinetry, the appliances, the lighting fixtures. The taxation code of USA, because we are in USA, it states that you can write off appliances in 5 years, by the way. Why? Because they will burn out.
They will. I just had them replace my stove here today. Like this last, I think 2 weeks ago, they replaced my stove. Completely.
Exactly. See, so that's why when with Trump coming into as president, he even did the bonus depreciation for 2019 and a portion now in 20 and then 21. But what that means is in the taxation, how it helps now. Let me explain. What happens is when we are doing accelerated depreciation or cost segregation, same thing, by the way, same thing.
Okay.
So what we are doing is when you get a LLC, limited liability company, LLC, that's what it is, and you are buying an asset, you are buying a building in that LLC, you don't pay taxes at the LLC level. That's the wording. What that is, we run the operation of the LLC by counting all the rental income, all the income from the laundry machine, all the income from valet trash, parking, all that, right? Or also
storage units, whatever it is.
Right. Rubs is another thing, which is
garages, covered parking.
You got it.
Tons of it.
Covered parking. Yep. Pet wash, pet dog wash, cyber cafes, all that stuff, right? So that is income. Then minus expenses. So when the CPA does for taxation purposes for the real estate, they will take the income, they'll take all the expenses, like all the expenses of taxes, of the property tax now I'm talking about, insurance, all that money, right? We are giving for the marketing costs, contract services, we are giving money for payroll, to run the property and all that stuff, right? And the maintenance, I forgot about that. Maintenance is a huge part. So then we come out with the NOI. But in the taxation, CPA puts one more line item. It's called depreciation. Oh my gosh. So that's a negative paper loss. So the property could be making profit all the way through. But
you're still showing a negative loss.
You got it. Because hundreds of thousands of dollars can be written as depreciation loss. That makes the positive go into negative or reduces the total cash flow or net income by the depreciation amount, and it might reduce the amount, right? So let me kind of share now what's the effect of that for the investors. Because
I didn't even think about that side of it.
Exactly. See, because like I mentioned, in the LLC, we don't really pay taxes. So us, like in our company, I've done 28 syndications now, 28.
Which is huge.
Complete, and we have sold 21 of them or so right now also. So, which is good. We have completed the cycles, given money back.
Love it.
Investment, all that. And they're bringing millions back again for the next ones, senior living, all that stuff that we are starting. But the big part is with the pass-through entity, what we do is that the loss which is there at the bottom, it runs into K1. There is a term called K1.
What does that mean?
K1 is a form,
Okay.
IRS form, which actually takes the profitability of the LLC and divides it up into its members. That's the way to say that, right? So it's a K1 format of a form where we show how much distribution we gave to the investors.
Okay.
They are getting the cash flows, right?
Mm-hmm.
But then in the number 2 box on the top of the K1, we say net income or loss from the entity. So that is the amount which could be minus, even though our investors got the cash flow, quarterly cash flow we give. Some people give monthly, we give quarterly, but then they don't have to show all that dividend or the distribution because the K1 shows negative. K1 shows negative. Now, for those people who are passively investing, it's a passive loss. It's a passive loss. But those people who are actively investing in real estate, which means like becoming a real estate professional, in other words, you have to spend 750 hours in a year in looking after your business in real estate. That's what the stipulation is.
Really? I had no idea.
Yeah.
I think I qualified.
No, you might. But let me ask you another thing. The other stipulation is that you need to be working 51% of the time.
Not 50, but 51%.
51%, because over 50%, more than your regular job.
Okay.
Because if your regular job, you're putting 2,000 hours, guess what? Now
you need to be working 1,001 hours too.
No, you have to work 2,000
or 2,000. I'm sorry,
hours.
my math wasn't going there.
Your 750 hours increased to 2,001 hour to be able to claim real estate professional status. That's why a lot of people can't do it unless listen to this one now. Doctors, attorneys, a lot of people who are making a lot of money, but moms are stay-home moms.
Yeah.
So the stay-home moms are not doing any other business. So if they can log, and legally, I'm not a CPA, but they can talk to their CPA and other people, then they can get into real estate and qualify as a real estate professional. That will save bunch of taxes. And now today is the discussion about taxes. That's why I wanted to kind of give the whole scope of things,
the whole picture.
What can happen when you are a real estate professional? You can take your active losses in the future till eternity. You can keep them. Passive losses also can be taken till eternity. But when we sell the apartment or whatever, we call it gain, equity gain. Now that is also passive equity gain, which can be batted against all the losses for so many years. And then you get a big bump of the gain. You could take that two together, then you don't have to pay much taxes, you know. So if I may make it simple for everybody listening to me and following us and watching us, right, Alicia, is real estate has the best tax laws in this country. Real estate has the best tax laws. The majority of the wealthy people own real estate.
That's true. That is true.
It hedges their income. It hedges their regular incomes and other incomes. So that's why I try to say to everybody, please get into real estate, because that will give you active losses, passive losses. See, because if you're putting your money in stock market, and most of the people do, you can write off $3,000 each year. I think it's 3 still. I'm not too sure. But the key thing is in real estate, you can take hundreds and thousands of dollars of losses. I mean, people make millions of dollars like myself.
Just on showing on paper the loss.
Exactly.
Love it. And how does the government help with multifamily compared to like a single family or like, stocks and bonds and all that, stock market investment? What's the difference and how does the government help you with, syndication and multifamily?
I'm so glad you said that, Alicia. Now in the stock market, if you lose $100,000 in a year, you can only write off $3,000. I should get with my attorneys and CPAs, but this is what I remember back then because I don't really even look at it because I don't have lost.
Yeah, now they just do it for you, but yeah.
Very well with the biggest bull. There might be some, downturn and so forth. But the thing is in the real estate, there is leverage, first of all. What that means is you can put only 20% down of your money or 30% down on your money and the bank gives you loan of 70%. Now you're owning an asset of 100% with only 30%. It's the leverage, right?
Yep.
But the banks are not.
But you write off the full amount.
But you write off the whole amount because banks don't come to me and say, hey,
Ninja.
The taxation piece that you are taking, give it to me. Not at all. That's the difference between Wall Street and real estate. Big differences right there. Leverage, because if you want to buy Google stock or Amazon stock, you have to pay $1,400 or $1,300, whatever it is. Nobody's going to give you money to give you half and then you pay half.
Because you have nothing substantial. It's just paper, basically.
It's paper.
Right. You're trading paper.
Alicia, you're right. So essentially, the banks give you loans, but they walk away. They just want the interest payment.
They get the interest, you get the tax benefits.
You get the tax benefits, exactly. And the laws in the country are such, taxation laws for real estate, they say it depreciates. So that's the other loophole, which I'd say the stocks don't depreciate. They lose value or
they lose value. They lose value. It is what it is.
But in this investment in real estate, the day you buy it, just like when you buy a car
you lose money.
A Mercedes Benz, and you drive it out, or BMW, or
you just lost 10,000 right there.
Lose it. Yeah, exactly.
Driving off the lot.
Loses its value. Same thing. Depreciation is the same schedule. You buy a property day one. As soon as you bought it, you get to write off all the expenses, first of all, of closing the sale and everything. And then you depreciate the structure, the buildings and all parts of the buildings over the next 27.5 years. So that's where you are able to make a lot of profit, a lot of money. But when the paper loss comes in, that's paper loss makes it negative. And that's why a lot of people say wealthy people don't pay any taxes, even though they make a lot of money.
No, that's totally true. And I me, I'm money hungry. So I like the way the business model works.
Yes.
To me, I love it because you got the indefinite depreciation instead of like if you just had your money in like a 401k or something like that, where like you say, you can only write off a certain amount. In which, guys, you all have to like get your own tax attorney. Vinney is not one. No. He's not a CPA, and neither am I. So let's clarify that. But so tell me the do's and don'ts when dealing with taxes in the multifamily industry or syndication industry.
Totally. The biggest thing is that you definitely want every asset in a separate entity.
Okay. Huge. Every asset. So you have 28. So you did 28 different LLCs to accomplish that. Okay.
Totally. Because you don't want the risks of one investment flow into another one.
That makes sense.
Because what limited liability companies, LLCs, mean that you can lose the principal, you can lose the money which is in that LLC, but it will not affect your other businesses which are limited liability also. See?
Yeah.
So that's very, very crucial. The second part is, Alicia, that you are doing a great CPA. Get somebody who will
pay the money. Don't cheap out on it. Pay the money and get a good CPA.
I mean, you talk about hundreds of thousands of dollars of investors and your money. So you want the right attorneys. I believe in that. Right CPAs, right CPA strategists. Oh, wow. Now there are taxation coaches, taxation strategists who don't do the filing for you, but they teach you and they show you what to do during the year. See, filing the taxes is after the year is done. But you need the coaches and the strategists to teach you what you're doing during the year and where to put and how to.
Yeah, where in what category do you put each situation in?
Totally.
That makes complete sense.
And in this whole podcast, I'm sorry, something in my mind is also I should talk about tax deferral strategies. Now, what
tax deferral strategies?
What that means is like 1031.
Yes, I know what a 1031 is.
Okay, you did. Yeah, you might have heard. A lot of people in the audience must have heard. What that means is you're selling an asset, but
you're just rolling the money over and not paying taxes on it.
Yeah, you're buying another asset within 6 months. You have to close it, but you have to disclose 45 days before or after the sale to tell 3 different assets. You could buy one of that one, but you got to start beforehand so that you don't have to pay the taxes on the capital gain. I wanted to mention that.
I think hiring a tax attorney CPA is key to the multifamily business.
It really is. I'm telling you, I mean, they've saved thousands and, thousands.
It's worth spending a couple $100 to do it and then be able to close it on that. But I do want to ask you a couple more questions real fast. So I don't think this has actually happened, but I got to ask you, have you ever been behind on your taxes? And if you did, how did you deal with it?
You know what? Good point. See, in my case, we give the K1s to hundreds of investors, right? And we have thousands of K1s because I have so many investors in different properties. So each property, each investment gets in K1, right? Then we have 1099, probably thousands, again, close to it, vendors that we have because we manage our assets, right? So my accounting department is very, very busy for 3 to 4 months. They are actually busy 5 months because they start preparing in November, December, closing the books faster and then working on this. So saying that, my taxes are usually extended to October, as you all know. April 15th is the day, or March 15th.
So you get a 6-month extension.
Yeah, 6-month extensions. So, but I did get audited 1 year because we donated a lot of money to charity.
Okay.
And they said, how can somebody donate so much? Anyway, but
it's a good cause. Sounds like a pain in the butt, but it's a good cause.
So they didn't find anything. But anyway, that was a good thing. But one more thing I wanted to mention was the IRAs, 401ks, EQRP. These might be very different names to a lot of people listening to me, but they are the tax strategies also to defer the taxes. Like Roth IRA, when you pay taxes right now and you invest after tax dollars into real estate or anywhere, and you keep on making 10 times the money, you never have to pay a dime to the Uncle Sam. That's the Roth IRAs, after tax retirement plans, right? But there are other retirement plans where you can have a checkbook control, it's called. Checkbook control, EQRP, qualified retirement plans. They are called KEOG plan, all different kinds. I'm not one professional like that, but I know a lot about it. So
it's not your first day.
Yeah, seek out, and you can reach us and my account.
Yeah, I mean, I'm sure you've got a ton of really good referrals. I know we interviewed Kim, but
yes, we have
Kim Lisa Taylor. We had on the show recently, and she's an SEC attorney, and I know she's very qualified. And I'm sure you have lots of recommendations. Definitely, if you guys have any questions,
this page is free, as you can see, blank, but it's going to be like my company's in the front. We are going to put the affiliates and your name.
So that way you can kind of, for whatever you need. Yes. I love it. So I love to end each one of our shows with a nugget of advice from you about whatever subject we're talking about. Right now we're talking about taxes. So what is your number one piece of advice for somebody who's new into the business and hasn't closed their first deal, but needs to make sure that the deal doesn't go to crap because they didn't do their tax part the right way and they lose their butt? So what's your advice for somebody like that?
I would definitely say education is number one, right?
Okay.
Alicia, so it's not that complicated. Sometimes people make it
make it more complicated than it needs to be.
Yeah, than it should be. I think there's a lot of good literature at the CPA's website. You could go to some of the very good real estate CPAs. You always should look for real estate CPAs.
Somebody specializes in
dealing with real estate. Go on their website, look at their frequently asked questions. You can even do a 30-minute session with a good CPA because they would love to kind of teach you, show you.
Yeah.
Because they want their business,
They're trying to close the deal too. So I get it.
So
I love it.
Don't take it in your hand unless you are very, very capable of, yourself. You might be leaving thousands of dollars on the table. That's how I'm saying. You might be saving 500 or 1,000, but losing 10,000 in deductions and things like that,
So the piece of advice is make sure you got the right people in place to make sure your taxes are done right. I love it. All right, Vinney, I so appreciate your time today. Guys, don't forget to like, comment, and share, because if you're getting into multifamily business, this is the podcast for you. Guaranteed. Vinney always gives the goods, and I'm always digging into them.
Say that, Alicia. Actually, I got something together. My team said, Vinney, you're doing so many shows now. So I just want to talk about this. The first book, International Bestseller. My second book is coming out. Positivity Brings Profitability. Then my 2 podcast shows over here got really raving reviews. Please like us and comment and then share it all across the globe. My thinking is big, very big, and you'll see so many new initiatives that I'm putting together. We just started a branding company. It's the Digital and Print Branding 2030. That's the new name of the company. And then also my cyber defense company and senior living company we just started. And then my Monil education company, which is a brand new company I just started.
Now I know why you hired John, because you need somebody to keep up with all your companies. There's no way you could keep up with all that.
And Oxygen. Sorry, I forgot.
Yes, Oxygen. I remember that. Yes.
Also I
like that. That's actually a ninja company. I love that. I like the way you presented that. That's ninja for sure. Okay. All right, Vinney. Well, I really appreciate your time. I know you're busy. You've always got meetings. He's always running. He runs faster than my 5-year-old for sure. She runs me ragged, but he definitely has more energy and
appreciate
always going, always making money, always bringing positive light to everybody's life, and always giving out the goods. So guys, don't forget to like, comment, and share. Vinney, I hope you have a great day, guys. And this is Syndication Made Easy with Vinney Chopra.
This morning. See you next week. Guys,
sounds good.
Like us and give comments, because it's because of you we are here. And we want to give you the very best and share with your friends and all, and go on a ride with us and conquer that whole decade. 2020 to 2030 belongs to you, but you got to make a decision.
But you got to get it. You got to grab it. Got to get the information, and we got it for you. So tune in each week and get your tips for Syndication Made Easy, or you can jump on our motivation podcast also, where we do a motivation power talk, and that's really awesome too.
Mr. Smiles, what is we call?
Yes, Mr. Smiles
Motivation Talk Show. There we go.
Yep. And you can see obviously why it's called Mr. Smiles. But guys, I hope you guys have a great week. So until next week, Vinney, cheers. I will see you then.
Bye.
Be sure to listen to Mr. Smiles next week with more golden nuggets and top-notch coaching tips. You can reach him by going to VinneyChopra.com. or texting the word syndication to 474747. Be sure to like, comment, and share to show everyone how Mr. Smiles has brought your apartment syndication business to the next level.